Hey everyone, welcome back. Today we're diving into GPIQ, the Goldman Sachs Nasdaq 100 Premium Income ETF. If you're looking for a way to get tech growth and steady monthly income, this fund might be worth a closer look. By the end of this video, you'll know how it works, what returns it's giving investors, and whether it could fit in your portfolio. So what exactly is GPIQ? It's an ETF that launched in October 2023. At its core, it gives you exposure to the Nasdaq 100, which means big tech names like Apple, Microsoft, NVIDIA, and Amazon. But GPIQ isn't just a regular Nasdaq fund. It uses something called a covered call strategy to generate income. Here's the simple version. The fund owns these stocks, but it also sells call options on them. Think of it like renting out part of your investment. You get paid a premium for giving someone else the right to buy your shares at a set price. The result? You get potential growth from the underlying tech stocks, plus extra income every month from the options. It's a way to combine growth and income in one fund. Now let's talk about what makes GPIQ stand out. The expense ratio is 0.29%, which is fairly reasonable for an actively managed ETF. It has about $1.5 billion in assets, so it's big enough to be liquid but not too massive. The yield is almost 10%, paid monthly, which is much higher than most traditional equity ETFs. And the top holdings? Apple, Microsoft, NVIDIA, Amazon, and other big tech names. The top 10 make up over half of the fund. So, you're getting high-quality growth stocks and strong income at the same time. Of course, the big question is always, what kind of returns are we talking about? Year to date, GPIQ has returned roughly 12 to 13%, combining price changes and dividends. Over the past year, total returns, including income from options, are about 25%. Remember, past performance doesn't guarantee future results, but these figures show how the strategy has worked so far. Let's take a closer look at that covered call strategy. Basically, you own the stock but you sell someone else the right to buy it at a set price. You collect a premium for giving them that right. If the stock goes up a little, you keep most of the gains. If it jumps a lot, some gains are capped. If it drops, the premium helps cushion the loss. GPIQ uses what's called a dynamic override strategy. That means it adjusts how many calls it sells depending on market conditions. In other words, it tries to balance income and growth, so you don't give up all the upside in a strong market, and you get more protection if things dip. Of course, no investment is without risks. First, upside is capped. If the market rallies strongly, you might miss some of the gains because of the option strategy. Second, volatility risk. The underlying stocks are still tech-heavy, so big drops can hurt. Third, concentration risk. The fund is heavily weighted in a few mega-cap tech companies. So while it offers income and growth, it's not risk-free. GPIQ may be a fit if you want monthly cash flow, like tech growth, but also want some risk management. It's not ideal if you only want pure growth or if you're uncomfortable with volatility or tax complexity. It's a specialized tool for the right type of investor. So in short, GPIQ is a hybrid ETF. It combines tech growth with premium income. It's not perfect, but for investors looking for income plus exposure to big tech, it's an interesting option. Thanks for listening. If you found this helpful, make sure to subscribe and drop a comment.